Well, hello, Providence Financial friends and family. Anthony Sicaro here, founder and president of Providence Financial and Insurance Services located in Woodland Hills, California. And this is a monthly market update, something that last month I had told you I would try to do more periodically, just give you some kind of an update as to what's going on. And that's the purpose of this. Now, this is designed primarily for our clients. If you're a client of ours, thank you for your business. Thank you for your trust. You know that we don't take it lightly. If you're not a client of ours, feel free to learn more about us at providencefinancialinc.com. Let us know if you have any questions. This is going to be short. There hasn't been a lot of change over the last month or so with regards to the market. Right now, the eyes are on the Federal Reserve and what they're going to do. And the Federal Reserve's eyes are on a couple of things, primarily GDP and inflation. And we're kind of at the point in time where there's an interesting dynamic going on where inflation is higher than growth at this point, and that creates an environment that is often referred to as stagflation, and that's not a good scenario either. But what it does is it puts the Federal Reserve in a pickle because they really don't know what to do. So let's talk about a couple of things real quick. Let's talk about GDP. Let's talk about inflation. Let's talk briefly about the labor market. Let's talk about tariffs real quick, and then let's talk about interest rates, and we'll kind of commingle those as we go through. GDP, gross domestic product. GDP is the growth of the economy. GDP was at 2.8% for 2024, which is a healthy GDP. And then in the first quarter of 2025, GDP was a negative 0.5%, and then it bounced back up to 3% in the second quarter of 2025. The first quarter was somewhat of an anomaly because the tariffs were getting put in place. A lot of companies in the fourth quarter front ran, however you want to say that. They tried to get in front of tariffs, and they front ran the tariffs, meaning that they loaded up on inventories, bought another 60 to 90 day supplies of inventories in the fourth quarter of 2024, which helped boost 2024 GDP. But then in 2025, they didn't need to buy any more goods because they already had full warehouses trying to buy what they were going to need for the next 90 days before the tariffs. So it made for a strong 2024. It made for a weaker Q1, negative GDP for Q1. And then Q2 it bounced back because they had to go back and buy some more goods, but fill up their warehouses again with inventory. Now the tariffs, along the same lines, something that if you've watched me on TV report, it's more of a political play than reality. It doesn't mean that they're not going to be there. But Trump has talked about 25%. That's been a number. They've settled down to 10%. Some of the tariffs for other countries have gone away. And there's supposed to have been this negative inflationary impact as a result of tariffs. We haven't seen it yet. Even now with China and Russia, there's on hold with the tariffs. So there's some pause for negotiation and so on. So we really haven't seen the inflationary pressures of the tariffs yet, because it's more of a political ploy. Now, at some point in time, they're going to settle in probably around 10%. And I don't know that that's going to have a huge economic impact on the consumers. A lot of times the importers can eat the tariffs. The companies in America can eat the tariffs, and there's different ways to offset it without it necessarily passing on to the consumer, or without it passing on to the consumer in a big way. I think the reports that I've seen have indicated that for a single person, if the tariffs go into effect the way that they're expecting, it might cost an extra $1,200 a year for imported items. Goods come in from China and Mexico and so on. And for a family, it might be an extra $2,400 a year. So I don't want to say it's not there. It just doesn't seem to be as inflationary, as impactful, not enough to ruin families, if you will. But it's there, something that we're keeping an eye on, and it's something that the Federal Reserve is keeping an eye on, and it's the unknown with the tariffs. We don't know what Trump's going to do. He's pretty unpredictable, and so we don't know where it's going to settle in. But the tariffs is going to have an impact on inflation to some degree, but I don't think to the degree that a lot of people have thought. So GDP was strong in 2024, 2.8%, negative in first quarter 2025, strong in second quarter 2025, and it's predicted to be about 1.5% for the entire 2025, which is about half of what it was in 2024. So that means that that growth is slowing. That means growth is slowing. Now, part of the reason why growth is slowing is because the labor market is slowing. A couple years ago, I was reporting that the labor market had almost 2 jobs available for every worker. So, in other words, there were more jobs available than workers available to fill them, which then means that there's a demand for workers. If there's a demand for workers, companies have to pay more for workers. And if they have to pay more for workers, then they have to turn around and pass that expense on to the consumer. And that's been inflationary. And that's a sticky inflation, because once you give a rate, or once you start someone at a higher wage, or you give a raise to someone to keep them because they know they can go look in another job and make more money somewhere else, so they wind up getting raises, you can't take that back, and that causes inflation to be sticky. So inflation between 2021 and 2024, inflation went up about, I believe it was like 21% or so. That's not going back. We're not going to give that back, even though the inflation numbers have come down. Now, speaking of inflation, and actually before we move on, the wrap on that is that GDP is slowing down because the labor market is slowing down. Right now, it's like 1 job available for workers. So there's not as much of a demand for workers, so companies aren't having to pay as much. And that's a big reason why inflation has started to come down as well. If workers are making more, they have more money to spend. If they spend more money, GDP goes up. If they have less to spend, then they're not going to spend as much, and GDP goes down. So it makes sense, and that's it's all tied together. The inflation and the higher inflation we saw in the past few years had a lot to do with the labor market. The lower growth that we're seeing in GDP, the fact that inflation is coming down, is also a direct correspondence to the labor market. Let's talk about inflation really quick. There's a lot of different ways to measure inflation. There's a PCI, there's core PCI, there's the PCE, there's core PCE. The Fed's preferred inflation measure is the core PCE. It's the personal consumption expenditures. Core PCE means that they don't include food, they don't include energy, because those are cyclical, so they like to look at those without. Their target is 2%. What they want to do is they want to get that down to 2%. Right now it's at 2.8%, so well above that 2% level, but it has come down, but it's been under 3 for the last 6 months. I think it hit 2.9 or so in February, but it's been in the same range for like the last 6 months, so it hasn't continued to come down. And the Fed, of course, is hoping that actually happens. So that's one of their measures. They want it to get to 2%. Now, the reality is that it's never going to get to 2%. And when you look at the long-term average of PCE, it's in the mid-3s. So it's really well down from what the long-term average is, but for some reason, they've got their sights set on 2%. That's what they've been talking about for years. Hasn't been there for years, but that's where they want. Now, at the same time, it's important to understand that they can't wait for PCE to get to 2% before acting. Inflation is a lagging indicator, meaning that whatever happens today is going to show up in the inflation numbers 6 months down the road. If tariffs get put in place today, it doesn't show up for 6 months. It's lagging because it has to take time to go through the system. If the Federal Reserve lowers interest rates today, it doesn't show up for 6 months down the road because it takes time for that to work its way through the system. So the Federal Reserve can't wait until it gets to 2% to make some moves. They want to see it trending in that direction before they actually start to lower rates. And they haven't seen it trending in that direction. So the challenge is that GDP is slowing down, as we talked about, but inflation is sticky. And then the question becomes, well, what do? They want inflation to come down. And if inflation comes down and the labor market comes down, softens, and GDP comes down, then it's a slam dunk. They've got to lower interest rates. But now what we have is we have the labor market slowing, we have GDP slowing, but inflation is sticky. Inflation is still at that 2.8%. Now, with all that, I think the futures market shows that there's a 75% chance of a rate cut in September by the Fed. And that would probably be the right move. The question then is going to be, are they going to do a rate cut, which odds are that they are, and how much? Is it going to be 0.25%, or is it going to be 0.5%? I think they should do 0.5% in September. And the reason is because of the fact that inflation is still lower than its long-term average. and you've got GDP and you've got the labor markets down. So I think they should do 0.5% in September. I think that would be the right move for the Feds, and the futures market is telling us that that's probably what's going to wind up happening. Now, what is the impact on all of this as far as you're concerned? What if they do lower interest rates? What's that going to affect as far as you're concerned? Well, I just want to remind you that every single one of you have invested with us and have trusted us for the income, right? It's all about the income. If you listen to my radio show, we are your retirement income source, and this is the place where retirees come for income. Thank you for joining us today. And the reality is that's the tagline of the show. That's what we talk about for over 10 years now on the radio. And if you haven't listened to the radio show, it's a great information, by the way. I mean, if I'm a little biased, I guess, but you can go to providencefinancialradio.com and there's hundreds of episodes there. If you want to listen to it on the podcast, the radio show is turned into a podcast. Just go to providencefinancialpodcast.com or search for the Providence Financial Retirement Show on your favorite podcast player. And, you can listen to all the past podcasts. You can listen to, the episodes. I do these weekly. So here I am doing a YouTube video for once a month, but I do my radio shows every single week. I record them. We put them in the podcast. They're available. So if you, want more of an update or you want to learn about things, just follow us. Listen to that every week. And yes, I do it for the public, but it's the same information that I would be giving you, here on YouTube. The simple fact, though, is that you're invested for income. You're not invested for growth. Our goal for you is twofold: protect your principal, and get you 5 to 6% a year in today's rates, 5 to 6% a year of income, interest and dividends from your portfolio, without any effect on your principal. And that's what we've been good at. And other than maybe a few outliers, that's where you all are at. That's why you signed up. That's what we're doing. Now, sometimes, the questions that we get, and we don't get them often. I haven't even had any like this recently, because I think we communicate with you guys. I think you guys know the story, especially if you've listened to the radio show, read my book, you know what we're about. You know that your portfolio is going to fluctuate up and down, but your income's going to remain the same. But every now and then we'll get a question about, stock market did really well. How come my portfolio has just kind of stayed flat? Well, it's because you're not in the stock market. Even if you have some money in the stock market, you're not full-fledged in the stock market at all. And what's interesting to know about the stock market, you look at the S&P 500, right? The 500 biggest companies in the world. Well, it's a company-weighted index, which means that the bigger the company is, the more weight it has on the index. And the stock, the market did 24, I think it was almost 25. I don't think it was quite 25% in 2024. But out of 500 companies in the S&P 500, the top 7, what often referred to as the Magnificent 7, those companies, what's up with the balloons? I don't know. That's funny. See, if I do this, does it do? I don't know. Something happened. There you go. I got some balloons now going, so I'm not sure how that is. Sorry for the distraction. Let's go back to 2024. In 2024, market up almost 25%. But if you eliminate the top 7 stocks, 7 out of 500 stocks, you're going to be amazed. If you eliminate the top 7 stocks, the S&P 500, the other 493 companies were only up, it was less than 5%. That's amazing. In other words, the top 7 companies, the Mag 7, control the entire S&P 500. And if you look year to date, it's similar. As a matter of fact, if you look year to date with the S&P 500, minus the last couple of days that have been really good, the S&P 500 was actually negative when you take out the 7 biggest stocks of these 500 companies. But it's easy to look at the S&P 500 and go, well, it's up 25% or it's up 10% or, whatever. When in reality, it's very much driven by these 7 stocks that are controlling almost the entire S&P 500. And when you compare that to our portfolios, year to date, our clients' portfolios, your portfolios are up, 3 to 4%. So not far lagging behind the S&P 500. But again, it's not about the total return. We don't care. You shouldn't care about the value of your portfolio, because what you care about is you care about the income that's coming in. And I know you know that. This is just a reminder. But it's about the income that's coming in. So and what you really want is, the portfolios over the last couple of years, income portfolios have generally come down. Why? Because what affects the value of income portfolios more than anything else is interest rates, not the stock market, interest rates. And interest rates have gone up. We had the largest, fastest increase in interest rates from 2022 to 2024 that this country has ever seen. Federal Reserve raised interest rates from 0.25% up to 5.5%, and then they pulled back a little bit now over the last year, but massive increase. And if income portfolios react opposite of interest rates. So interest rates go up, income portfolios go down. Interest rates go down, income portfolios tend to go up. Now, if you are living off your income, then it doesn't matter that fluctuation because your income is going to stay the same. And you're not cannibalizing your principal. So whether your portfolio is here, whether your portfolio is here, if you're living off your interest and dividends, there's no effect on you. But on the other hand, if you are reinvesting your interest and dividends because you're not spending them, well, the fact that over the last couple of years, the portfolios tend to have come down a little bit, income portfolios have come down, that's actually a huge advantage to you because now if you reinvest your interest and dividends that you're not spending, you're actually getting a discount on those interest and dividends because everything has come down a little bit. So the best thing that could happen to you is that everything kind of stays here at this level. Now, when interest rates go down, if the Federal Reserve lowers interest rates over the course or in September, and they're expected maybe one more time through the end of the year, so maybe they do a percentage between the two rate cuts over the between now and the end of the year. If that happens, what's going to happen to your income portfolios? Well, we don't know for sure, but they may not change. Now, you might say, well, wait, I thought if interest rates come down, my portfolio is going to go up. Yes, but what's happened is we've had, for 2 years, from 2022 until December 2024, we had an inverted yield curve. And an inverted yield curve means that you can actually get paid more for short-term investments than for long-term investments. But that yield curve is uninverted. So the Federal Reserve controls short-term interest rates. They don't control long-term interest rates. So an inverted yield curve, if I can, kind of goes like this. It's like a rainbow, kind of goes like this. So as the Federal Reserve lowers interest rates, what's been happening is as you have this inverted yield curve, and I don't know if I'm going to do a great job of explaining it, but as you have this inverted yield curve and they lower short-term interest rates, then the long-term interest rates over here, I think I'm doing a horrible job, sorry. The long-term interest rates have not moved. So instead of the yield curve being like this, it's uninverted. Now it's like this. And for income portfolios, it's more the long-term interest rate that has an impact on the value, not the short-term interest rate. So I think I might have confused you. I apologize for that. But because we've had this inverted yield curve for a couple of years, and because the Federal Reserve lowers and controls the short term, not the long run, and because the long term yields haven't really moved. They moved a little bit, but they've been stuck in that 4 to 4.1 to 4.5 range now for months, probably the last year or so they've been there. When the Federal Reserve lowers in September, it may not have an immediate impact on your portfolio, but that's okay, again, because if you're taking income, it doesn't matter. And if you're reinvesting your income, you really don't want the portfolio to go up in value anyway, because now if you're reinvesting, you wind up paying a little bit more than if everything stayed where it is. So the impact on you is really no impact, regardless of what the Federal Reserve does at this point with your fixed income portfolios. One more thing, and then we'll call it a wrap. That is with regards to annuities. I think I mentioned this last time, but I just want to remind you that annuities are the best I've seen them in the entire 25 years that I've been talking about annuities. I've been an annuity expert. And the reason is because financial institutions, including insurance companies, which are the issuers of annuities, they make money. They do well when interest rates are high. And annuities today are going to certainly outperform annuities that were issued from 2021, 22 prior to that, because those annuities were issued in a lower interest rate environment, and annuities issued today as a high interest rate environment. And so what that has given a lot of you the opportunity to do is to upgrade your annuities into an annuity that just makes a lot more sense. Annuities that will pay more income, annuities that might give you that will give you higher returns. All the way around makes sense. And I think we've done that for most of you. But if you have an annuity that is more than 3 years old and you haven't upgraded it yet, call Twan in my office. Make sure you have him look at it, see if it's something that's worth doing. So that's it. If you have any questions, of course, my office is available to you always. Again, I appreciate your trust, appreciate your business. Don't hesitate to go to listen to my radio show podcast, providencefinancialradio.com, all the past radio shows, providencefinancialpodcast.com, all the podcasts, or again, just search for the Providence Financial Retirement Show on whatever your preferred podcast player is. You'll be able to listen to it there. Thank you. God bless.